Are you ready?
Ready.
All right, let's go. Kevin here, Top 1 Financial Advisor and best-selling author. We are here to talk about the stock market. The other day, I got an excellent question about index funds and whether it makes sense to invest in index funds and individual stocks. What are the benefits? What are the drawbacks to that? So in today's video, we're going to explain what index funds are, what are the benefits of them and the disadvantages, and also what happens when you combine individual stocks as well as index funds. So first, you might be new to the channel. You don't know what an index fund is. I'm going to explain that for you. But as I do, go ahead and hit that like and subscribe button. All right. So an index fund is one of the most revolutionary investments out there. And essentially what it is it gives you the ability to invest in hundreds of stocks all at once. For example, one of my favorite index funds out there, the ticker symbol here is ITOT. It is the total US stock market. Every stock that's out there in the US is basically comprised and packed into this one index fund. The benefit for me is that I don't have to sit here and choose and hope that Disney is doing well or ExxonMobil is doing well and guess wrong, right? And lose money. Imagine if I was investing at this point, something in SoFi, that would be awful for me right now. Or PayPal, that would not go so well because some of those stocks have lost, 40, 50%. That's the risk when you choose an individual stock. However, if I'm choosing an index fund, I'm already diversified. I'm instantly diversified because the money that I put in there is spread across the entire US stock market. And more often than not, the US stock market tends to do well. Not every year. 2022 has been a little shaky. But if you go all the way back to 2000, so last 22 years almost, you can count on one hand for the most part how many years have been negative. That is a good thing. Okay, so I lower my risk and I get to spread out and diversify my investments. That is the benefit of an index fund. The disadvantage of an index fund is that you don't really have control over what's in the fund and what is not. For example, the market on average is going to get you anywhere between 7 to 10%. Again, that's an average, that's not a guarantee, and you can almost never find one year that has done that. Again, that is an average. You're taking all those years together, you multiply it, divide it, all that kind of stuff, you get anywhere between 7 to 10%. Well, in a year where the market is down like it is so far in 2022, well, you're going to lose that 15, 20%, whatever the market is down, and not every stock is down. There are some stocks that we've covered already this year. We talked about Eli Lilly. We're going to talk a little bit about McKesson and others where those stocks are up 30, 40%. And you're stuck with an index fund that's down 20. Well, you can't control that, right? So that is the disadvantage of an index fund. But again, more risk, more reward. So you want to take on more risk and do your research and decide to choose one stock or let's say 5 or 10 stocks. That takes a lot of time. That's a lot of risk because you could be wrong versus index fund where you say, look, I don't have to take on that risk, but I'm willing to accept lower returns, quote unquote, and get that 7 to 10% as opposed to trying to pick the right stocks and getting that 30, 40% return in a case like this year. It is difficult to do all those things at the same time. So is there a spot where you can, balance the two and does it make sense? Well, there's one thing we should definitely call out. The average investor cannot beat the S&P 500. That's the 500 largest companies. You can get an index fund that tracks the S&P 500. It is rare. It is extremely rare for the regular average person to beat the index. It is even, I can't say more rare, but even professional investors, people who create, index funds, take like a Kathy Wood and others who get paid millions of dollars to create pension funds and make mutual funds and do all these things, they cannot beat the S&P 500. So even people who get paid millions of dollars who went to school for this, they took tests for this, very rarely do they beat the index. I'll put this right here. I mean, we're talking 80, sometimes 90% of the time, they cannot beat index funds. So it is extremely difficult. And that's why index funds are, one, so incredibly popular and why so many people just go so hard for index funds because of stats like those. Okay. So all of that is true. However, there are always exceptions to the rule, and I'm going to show you exactly what that means and what that looks like. So can you combine index funds with individual stocks? The answer is yes, but there are certain ways that you want to do it. It obviously depends on what type of companies you decide to invest in. Again, there's a risk and reward factor here. Now, personally, I invest in index funds. I have about, I would say, maybe 80 to 85% of all my money in index funds. And I have a little slice of money that I like to put in individual stocks. Y'all see me do this on public. I have it in my own IRA. We talked about how I'm probably going to get rid of Meta because that's in my IRA. And I make sure that I have a maximum of 5%. That's as high as I'm going to go in any one company because I want to limit my risk, right? If I can afford to be wrong if it's only 5%, and I can afford to be wrong because the index more often than not is going to be right. So what I try to do is say, hey, look, I'm going to hit the index, maybe that's 7% in any given year. And then if I can choose the right stocks, I can do even better. But that's a big if, right? Again, Meta ain't one of them years for that, at least for me. Okay, so let's go ahead and I'm going to show you on the whiteboard what this looks like and what are some different scenarios. And what we're going to do is take actual numbers starting from January 2018 up until the end of October of 2022. So what I did is what we call this a back test, and it shows you if you invested this amount during this time, this is the exact amount that you would have at that point in time. All right, so I'm going to draw this out and then we'll kind of go through it. So we'll start off here. Again, we'll start from the top. So we're talking about January 2018 to October 2022. Now, the reason why I'm doing this is because November just started. So I don't know what the end of November is going to be like. So we're using actual numbers here. And let's say that you started with $1. Say start with $1 and then plus $100 per month. Okay? All right, so in portfolio 1, we'll just put P1. You are investing in that's not an I, there we go, ITOT. Okay, this is what's called a stock symbol for those that may be new, and you can type this in. I would encourage you to do this with iPhone or just Google, type in the $ ITOT. Again, this is the U.S. Total Stock Market Index Fund, okay? So let's go ahead and look at that, and let's say you have 100% of your money there. So every single month, you start off with $1, you put in $100 a month all the way from January 2018 to October 2022, $100 a month, you're putting it all in that. Every single month, all you do is hit buy ITOT over and over and over again, okay? That's portfolio 1. Now, portfolio 2, just put P2. In this one, we have ITOT, and this time it's at 85%. And then we have T-Mobile, TMUS, that's at 5%. Let me scroll up a little bit. And then we have, let's say, Eli Lilly, the stock we've talked about. We've got 5%. And then let's do McKesson, MCK. And that one is at 5%. Okay, same $100, but we're splitting it out. Okay, and then, so for example, just kind of recap, we have ITOT in portfolio 1, it's the only thing you own, put $100 there. In portfolio 2, we're splitting it up, and we say of my $100 every single month, 85% of that goes to ITOT, that's my index fund, and then the other 15%, I'm doing McKesson, Eli Lilly, and T-Mobile. Okay, just an example here. So I'm taking it, $85 goes here, and then the other $15 is split out between those 3 stocks. And you can really do this with $1,000, $100, whatever it is, just to give you an example here. All right. So next, let's go to portfolio 3 to give us a different look at this experiment. So if we go to portfolio 3, in this example, we have ITOT. So we're still investing in the index. We've got 85% here. But in this case, let's say that we did Disney at 5%, just like the other ones. Let's say we do Verizon, which is VZ. This one at 5%. And this also just say AT&T at 5%. Okay, so now you see our 3 different scenarios. Right? So we have 3 different portfolios. One is all index. The other 2 is 85% index and then 3 different stocks. And what we're trying to do is see, well, if we did that $100 a month, basically over the last 4 years or so, how much money would we have today and what are the benefits and the risks? So here are the actual answers of how much money you would have had at the end of October. If you had did this, you would have just everything inside of the index fund. You have $7,381 today, or at the end of October to be exact. If you did portfolio 2, you would have $8,281. And then if you did portfolio 3, you would have $5,492. Okay. So the best performance is here. And this shows you that depending on what stocks you have, in addition to your index fund, you could, so as you see, you could do better. But here's that risk. So over this time, right, you had 2018, 19, 20, 21, you're putting $100 a month, plus the 10 months of October. So that gives you about $5,800 that you have put into the market during that time. Well, in the last scenario here, you actually lost money. You lost money and you had an index fund, but you chose the wrong stocks. That is the risk of having an index fund plus individual stocks. You might be right, you might be wrong, but imagine investing for 4 going on 5 years and you lose money when you could have not taken that risk and put everything in an index fund and been fine. You could have walked out of here, you put in 58, could have walked out of here with about $7,300. Okay, that's one thing that you do want to pay attention to. If I am quote unquote good and I know how to do my research and I'm choosing the right investments, well, I could have walked out of here with $8,200, put in 58, got out 82, and that's not bad. But again, can you choose the right stocks consistently? If you do choose them consistently, can you ride it out when things don't go well? For example, right now, y'all know Google and Microsoft, some of my favorite stocks. I don't really plan on selling them, but in a year like this, where they're down double digits, you know, would I be able to continue to hold on to it for another 4 years and end up in a scenario like this? This is what makes investing in individual stocks very hard. It's really what makes investing at all difficult, because also remember, this includes 2020 where the market was down at one point. It includes right now for the most part in 2022 where the market is also down. So even though the market is down, investing for the long term, you can still be quite profitable in 2 of the 3 scenarios that we discussed here. Now, the last thing you may be thinking, which one should you choose? That really depends on who you are as an investor, how confident you are in your investing abilities, how often you may or may not watch these videos, and whether or not it is your flavor, right? Does it make sense to you? Do you want to go and choose individual stocks just to add just a little bit on top of what you're currently doing? Do you feel like doing that? Are you the one that wants to, do the research, choose the stocks, stick with them, make adjustments when needed? Or do you want to say, hey, look, I'm a set it and forget it type of person, and I can count on 50, 60, 70 years of history to tell me that I'm going to be fine more often than not? That is a question I cannot answer for you, but the math here is the math, and there is a case that can be made where you can invest in index funds and choose individual stocks. But again, that route is a little more risky. All right, so the last thing I'll say here is this. If you want to learn, one, how am I even coming up with these stocks? If you've noticed and you've been a subscriber for a while, you know that we, make adjustments. We make lists. I did a whole list of 7 dividend stocks that I thought made a whole lot of sense right about now. And we've been talking about Eli Lilly for a while now. Y'all know I've talked about T-Mobile for a while now, and you might be able to kind of get a few stocks that can help you out just a bit more and protect your portfolio to a degree. The other thing too, the software that I use to actually get these numbers, I've actually done an entire video of my favorite websites that I use that have helped me to research and choose better investments. That is all inside the members only. So a lot of what you have seen, including some of the stocks I think make sense and that were on that list, were used in this video as well. So all stuff here, the members been had, right? They didn't had it for a while now. So you want to make sure that you join the members only as well. That link is right here. If you liked the video, enjoyed it, other than hitting the like button, that does help me out. Let me know what you think. I haven't broken out the whiteboard in a while. So I like doing these education videos. When you ask great questions, I get to do great stuff like this. So let me know what you think in the comments below. All right, that's it for me. I'll talk to you later. Bye.